What if I told you that the global economy was never meant to be balanced? That every dollar in circulation was born with a built-in flaw, one that guarantees the world can never, ever repay its debt. We've been taught that central banks exist to stabilize the economy, to prevent inflation, protect our currencies, and promote growth. But what if the real design, the secret blueprint, was never about balance, but dependence? Because in this system, the debt is not the problem. The debt is the product. This is the story of how central banks quietly constructed an economy where repayment is mathematically impossible, and why the entire world still calls it progress. To understand how we got trapped in an unpayable system, we have to go back to the very beginning, to the moment when governments lost control of their own money. In the late 1600s, England was drowning in war debt. The crown needed money fast, but no one trusted the king's promises anymore. So a private group of wealthy lenders offered a deal. They would create the money the government needed in exchange for power. That agreement birthed the Bank of England in 1694, the first modern central bank. It was revolutionary and dangerous. For the first time in history, money wasn't created by labor or production, but by lending it into existence. The government issued debt, the bank created money based on that debt. Then it charged interest, and that interest. It could never be repaid in full, because only the principal was created, not the extra money to cover the interest. It was a silent trap, elegant, invisible, and profitable. What started as a wartime fix became the foundation for a global system of debt-based currency, where money only exists if someone owes it. Fast forward to the early 1900s, the U.S. had survived multiple banking panics, each time exposing how fragile its financial system was. In 1907, one of the worst crises hit. Banks failed, depositors panicked, the economy almost collapsed. But behind closed doors, the financial elite saw opportunity. That year, a secret meeting took place on Jekyll Island, Georgia. Attending were representatives from the biggest banks in America, J.P. Morgan, Rockefeller Interests, Kuhn, Loeb & Co., and others. Their mission, to design a centralized system that would give them control over credit, money supply, and interest rates. The result? The Federal Reserve Act of 1913, sold to the public as a safeguard against financial instability. But in reality, it handed control of America's money supply to a private banking network. Now every dollar in the U.S. economy would be borrowed into existence, either by the government, businesses, or individuals. The genius and cruelty of this system was simple. When all money is debt, repayment becomes impossible. If everyone tried to pay back all loans, the entire supply of money would vanish, because money is debt. And that's the hidden secret. The economy must always stay in debt just to function. For a while, gold acted as the system's restraint. Every dollar was supposed to represent a real physical asset. But the temptation to create more credit, to fuel wars, expansion, and political promises was irresistible. By the 1960s, America's debt was spiraling. The Vietnam War and domestic spending had outpaced the gold reserves. Other nations began demanding their gold back, sensing that the U.S. was printing far more dollars than it could redeem. Then came the breaking point. In 1971, President Richard Nixon made a fateful announcement. He temporarily suspended the dollar's convertibility into gold. A temporary decision became permanent. The dollar was now backed by nothing but faith and debt. With no gold anchor, there was no longer a natural limit to how much money could be created. The economy had entered a new era, infinite debt creation. From that moment, growth and borrowing became the same thing. Every expansion was fueled by new loans. Every slowdown was fixed by printing more money. The blueprint was complete, a system designed to grow through debt and collapse without it. Once the gold link was gone, the illusion of endless prosperity took hold. In the 1980s, credit exploded. Governments ran deficits without restraint. Consumers were encouraged to borrow for everything: homes, cars, education, lifestyle. Central banks learned a powerful trick. By lowering interest rates, they could force people to borrow more and make the economy appear strong. Each crisis, from the dot-com crash to 2008, was met with the same prescription: lower rates, print more money, expand the debt. But here's the paradox. The more debt we create, the more future growth we steal. That's why every recovery feels weaker than the last. The system doesn't just borrow money, it borrows time. When the 2008 financial crisis hit, central banks printed trillions in new money to save the system. But they didn't fix the flaw, they magnified it. The total global debt ballooned past $315 trillion, 3 times the world's GDP. In other words, the world owes $3 for every dollar it earns. That's not bad accounting. That's the design. After 2008, central banks claimed victory. Markets recovered. Stock prices soared. But the recovery was artificial, driven not by production but by liquidity. The Federal Reserve, the European Central Bank, the Bank of Japan, they all expanded their balance sheets, buying their own government's debt with newly created money. This was called quantitative easing, a technical term for inflating the financial system to avoid collapse. It worked, temporarily. But each round required more printing, more leverage, more distortion. Interest rates fell to near zero, and in some countries, below zero. That meant saving money actually cost you money. The result? We now live in an economy that cannot survive without constant injections of credit. If central banks raise rates, the system crashes. They print too much, inflation explodes. There's no escape. The economy was built this way by design. Now, as debt reaches unimaginable levels, a new phase is emerging. Central banks are quietly preparing for central bank. Digital currencies, CBDCs, programmable money with total traceability and control. On the surface, they promise safety and convenience. But beneath, it's the same architecture, just digitized. Debt will still be created by keystrokes. Inflation will still erode purchasing power. The system will still demand constant expansion. Only this time, every transaction, every loan, every repayment will be tracked perfectly. The blueprint is evolving, not ending. So what can we take from this 300-year design? Takeaway 1. Debt isn't an accident, it's the foundation. The economy requires perpetual borrowing to exist. Without it, money disappears. Takeaway 2. Central banks don't serve the people, they serve the system. Their real mission isn't stability, it's maintenance, keeping the illusion alive. Takeaway 3. Repayment is mathematically impossible. The system can only grow by creating more debt. That means the world's total debt can never be repaid. Not now, not ever. We live inside a machine that feeds on credit, powered by promises that can't be fulfilled. And every new policy, every rate cut, every stimulus is just another gear in motion, keeping the illusion spinning a little longer. The truth is, the system isn't broken. It's working exactly as designed. The question is whether we keep playing by its rules, or start learning how to live outside of it.